So, welcome to KBRA's fourth quarter 2021 Bank Podcast. This is Brian Ropp and John Rempe joining you from KBRA's Financial Institutions Group. Today, we plan on covering the key takeaways from the fourth quarter 2021 financial results for the banking industry, and we will also address the ongoing credit quality trends for our coverage universe, as well as provide our 2022 outlook for the banking industry. So, John, let's start with fourth quarter of 2021 and recent trends. What stood out to you that will help lay the foundation for our 2022 outlook?
Yeah, thanks, Brian. It's great to be a part of the KBRA Bank Podcast once again. And I hope our listeners find our insights to be useful. So I would describe the fourth quarter of 2021 and recent trends for the banking industry as extremely stable, especially considering the industry's strong earnings performance. For this podcast, we're going to drill down on the key drivers behind the strong earnings performance with a focus on components of total revenue and provision for loan losses impact on ROA.
So, John, starting with the net interest income side of total revenue, if we consider that the Federal Reserve has been at a zero interest rate policy now for almost 2 years, it would follow that net interest margins have been pressured for our coverage universe, which is reflected in the 43 basis point decline in median net interest margins over the period from pre-Fed cuts of third quarter of 2019 to the most recent quarter, fourth quarter of 2021, where our median net interest margin for our coverage universe was 3.18%. This is the lowest level since KBRA began tracking for our rated universe. So with the historically low point in median net interest margin, what have been some of the trends and underlying drivers that you see having affected net interest income trends and our outlook going forward?
Yeah, thanks, Brian. So if you dissect the moving parts of spread income or NIM, you have various components, including interest earning asset yields, as well as earning asset mix composition, including excess liquidity, liability funding costs, and PPP fee income. I'll go ahead and take the first component, which is liability funding costs. So the zero interest rate policy clearly helped the bank's ability to cut deposit costs and other liability funding costs, which at the onset of the Fed's rate cuts had an outsized benefit for liability sensitive banks. The median cost of deposits for the KBRA rated universe declined 90 basis points to 16 basis points for the fourth quarter compared to pre-pandemic or third quarter 2019. The peak quarter over quarter decline was 35 basis points in the second quarter of 2020, whereas the fourth quarter's reduction has been much lower at just 2 basis points over the linked quarter, reflecting the natural floor KBRA banks have reached with its deposit funding costs. Going forward, we expect a low overall deposit beta and delayed increases relative to interest rate hikes as banks' balance sheets are flush with liquidity going into the rate cycle. Brian, how has the earning assets side trended relative to earnings performance?
Thanks, John. So KBRA's coverage universe, as you know, are more commercial loan oriented, so therefore have a higher concentration in floating and adjustable rate loans, which has contributed to their asset sensitivity. The typical playbook to combat net interest margin compression is to grow your way out of it with loan growth. However, loan growth has proven a challenge as banks attempt to match their PPP loan forgiveness, as well as significant system-wide liquidity and a very competitive lending environment, including pressure from non-banks. A key metric that reflects the level of liquidity on KBRA's bank balance sheets is evident with the risk-weighted composition for zero risk-weighted assets, which at the end of the fourth quarter of 2021 was at 13%, which represents a doubling since the pandemic began, reflecting the growth in cash and zero-rated investments like U.S. Treasuries. So, John, what role did the PPP program play in earnings performance?
So the PPP program may have been created to support businesses during COVID shutdowns and to provide liquidity until economic activity improved. With that said, the program also provided some significant benefits to the banking industry. So let's talk about the PPP fee income impact. PPPs and interest income provided significant support to NIM well beyond the low 1% yield. In fact, PPP total income accounted for 65 basis points of return on risk-weighted assets for our coverage universe for 2021. When considering the average return on risk-weighted assets was near 2%, that accounts for just over 30% of risk-adjusted returns for the period. Brian, liquidity has also had a major impact on reducing funding costs, but how has the liquidity surge impacted earning assets?
Thanks, John. The liquidity surge has been well discussed and documented, but to further put the scale into perspective, the significant liquidity build for the banking industry is shown with deposit growth of over $4.4 trillion since pre-pandemic period of third quarter of 2019. And investment securities have grown a similar amount by $4.5 trillion for the industry. So despite the negative impact of excess liquidity on net interest margin, this level of liquidity positions the industry well to remix their balance sheets once loan demand warrants. So switching to a second non-recurring revenue source that had a dramatic impact on earnings performance. John, so how was non-interest income impacted by the record-setting mortgage banking originations that experienced back-to-back years of $4 trillion in mortgage production?
So to help put in perspective how significant the gain on sale from increased mortgage banking activity was, it accounted for 60 basis points of return on risk-weighted assets in 2021 compared to just 25 basis points pre-pandemic in 2019. The mortgage boom was almost 2.5 times more impactful on earnings this year compared to pre-pandemic levels, where KBRA expects mortgage volume and gain on sale margins to return to as interest rates rise moving forward. And lastly, I think we should point out credit quality. The KBRA universe continues to reflect a solid borrowing base with median NPAs at just 45 basis points, which represents the lowest level of NPAs in our 7+ years of recorded history. Consistent with the positive trends in credit quality would be reserve releases in 2021 that matched reserve builds throughout 2020, which was in part due to the CECL adoption, in which 60% of our banks utilize. So, Brian, we kind of highlighted the key drivers behind the earnings performance and trends for the KBRA universe. What are your thoughts for the industry heading into 2022?
Thanks, John. So to set the stage for our thoughts on 2022, I'd like to quickly recap the key fundamentals of our coverage at the end of fourth quarter 2021 that we believe will play a role in their performance going forward. So first, you have credit quality at peak levels with historically low NPAs and loan loss reserves back to their first quarter 2020 levels. Therefore, reserve releases should decrease going forward. You also have earnings power reflected by net interest margin are at historic lows ahead of expected interest rate hikes. Third, you have deposit costs essentially at their natural floor. And fourth, liquidity throughout the industry is also at record levels. And then fifth, two non-recurring revenue sources that provided a significant tailwind for return on asset performance throughout the pandemic are unlikely to be repeated. Those would be mortgage banking and PPP fee income. And then lastly, you have inflationary pressures getting reflected in higher compensation costs of non-interest expense. So going forward, KBRA believes that 2021 will be a tough comparable year for banks to match in 2022. The banking industry is well positioned to deploy the excess liquidity into higher interest earning assets in the loan portfolio to grow net interest income. Expected net loan growth in 2022 will help banks grow their way out of the trough net interest margin trends amid hikes in interest rates by the Fed, which should also be supportive of net interest margin expansion as floating and adjustable rate interest earning assets reprice. Deposit funding costs should also remain stable, with deposit betas are expected to lag with the significant amount of system-wide liquidity. KBRA expects overall credit trends to remain stable to improving in 2022, although without several of the positive tailwinds the industry benefited from in 2021 and 2020, while addressing inflationary cost headwinds. With that, I'll turn it back to you, John, for the last words.
Well, listeners, that's a wrap for our fourth quarter Bank Compendium podcast, and we hope you found it to be useful. We would encourage our listeners to read the Compendium research piece for more extensive information on all of the KBRA-rated publicly traded institutions. We look forward to speaking with everyone again next quarter. And as always, you can find all of our research at www.kbra.com. Have a nice day.